Forex trading for beginners, step-by-step tutorial for newbies. All right, so now here we have our content for today's tutorial. We're going to be starting with what exactly is Forex, and then from there we're going to head to how does Forex trading work. And now the next after that would be who and why trade Forex. Why exactly should we trade Forex, or why exactly do people trade Forex, and who are those that actually trade Forex? And the next is going to be getting started with trading Forex. This is actually going to comprise of so many things. And now the next after that will be the basic terminologies, that is those terms you're going to be hearing, those terms you need to get familiar with if you're going to be trading Forex. And now the next after that will be deep diving into Forex, all you need to know about Forex. And the final thing in today's video is going to be based on the key tips for new traders. All right, so yeah, let's get started. Now, what exactly is Forex? So Forex, which is actually the short for foreign exchange, is the global marketplace where currencies are bought and sold. It's the largest financial market in the world with over $6 trillion traded daily. So basically, whenever you say Forex is simply foreign exchange. It simply means you exchanging one currency for another currency. For example, if you go to the bank, if you're someone who actually receives money in other currencies, maybe you are let's say a freelancer, or you do jobs and you earn in other foreign currencies, you then head to your bank. All right, you head to your bank to collect that money, even though it's not the money for your country. But then after you collect the money, what you do after that is to exchange it to your own local currency. For example, I'm in Nigeria. My main currency is Naira. But then let's say I do earn from other income sources. I earn dollar, or maybe euro, or even pound. Let's say dollar for this scenario. So I earn $100, but then I cannot spend $100 in my country because my country's currency is Naira. So all I have to do is to simply head to the bank, collect that dollar, and then sell it to exchange for the equal Naira. So that is basically what Forex is about. But in Forex trading, instead of physically exchanging the money like we are doing in the bank, like I stated earlier on, all we're doing this time is we're speculating on the value of one currency compared to another. One thing you must take note of is that in Forex markets, we are always comparing between pair. All right, for example, let's say we have a Forex market of Euro slash USD. Another example is we have Forex market of GBP slash USD and the rest. The main idea is we always have two currencies, and now we're trading based on these two currencies. Each of these two currencies, that is, each of these pairs, have their own difference, that is, their own unique Forex market. For example, a GBP slash USD Forex market is different from a Euro slash USD Forex market. They all have their own unique Forex market. But the idea here in terms of Forex trading is we're looking at one of those markets. It can be that you want to trade just GBP slash USD market, and then if you're buying, you're supporting pounds. And if you're selling, you're supporting the other pair. All right, as we proceed in this tutorial, you would understand the explanation better. Now let's proceed. Now, how does Forex work? So in Forex trading, currencies are traded in pairs like Euro slash USD or GBP slash JPY. So like I said, in every Forex market, we have a unique market for different currency pairs. Like in this scenario, we have Euro USD. The Euro USD in this scenario has its own unique Forex market. The GBP/JPY has its own unique forex market, and several other forex peers out there. They all have their own unique forex markets. All right. Now, the first currency is the base currency, and the second currency is the quote currency. So, like I said, each of these currency pairs have their own unique forex market. All right. We have so many of them, so many of them. But then let's use Euro USD for the sake of an example right now. So let's say we're looking at just trading for Euro USD Forex market. Please note that whatever I'm going to be explaining based on Euro USD applies to several and all other Forex currency pairs. All right. So now the first in this case of Euro USD, the first currency here, which is Euro, is the base currency. And now the second currency here, which is USD, which is dollar, is the quote currency. All right. So now the exchange rate tells you how much of the quote currency you need to buy 1 unit of the base currency. All right. So let's break it down with an example. If the Euro USD exchange rate is 1.1, it means that 1 euro is equals 1.10 US dollar. All right. So if you think that the euro will get stronger, you buy. And if you think that it will weaken, you sell. So now let me explain this in a way that you all would understand. Now in forex market, like I said, you're either buying, selling, or you're just watching the market. Now if you're buying in a particular forex market, like in this scenario Euro USD, you are saying that the first currency is gonna beat the second currency. And if you're selling, you're saying that the second currency in the pair is gonna beat the first currency. I repeat, if you're buying, you're simply saying that the base currency, which is the first one, is gonna beat the second currency. And if you're selling, you're simply saying that the quote currency is gonna beat the first currency. This applies to every forex market and every forex currency pairs out there. It's the same thing. The first one is if you're buying, you're supporting the first currency in the pair. If you're selling, you're supporting the second currency. Another example here, GBP JPY. If I'm buying, that is, I'm saying that pounds is going to beat yen. And if I'm selling, I'm saying that yen is going to beat pounds. All right. So now let's proceed. Now, why do people trade Forex? Now, there are 4 reasons, although we have several other reasons, but for the sake of today's video, we have 4 major reasons why people trade Forex. Now, the first one here is liquidity. The Forex market is open 24 hours every single day for 5 days. So you can trade anytime, anywhere. This simply means that every single hour, all right, for the 5 days, that is from Monday to Friday, we have a whole lot of liquidity, a whole lot of money, a whole lot of cash flow in the Forex market. And like I stated from the start, we have about $6 trillion traded every single day. So you can imagine the volume of money that is being traded in the Forex market. Now, the second reason here is leverage. With Forex, you can control a large position with a relatively small amount of money, thanks to leverage. So in Forex market, even if you have a small amount of money, you are able to trade very big amount of money that you don't even have, but with the help of what we call leverage. So Forex gives us the opportunity to trade bigger amounts even when we don't even have that exact amount. Don't worry, as we proceed, you will understand what leverage is better on. Now, the third thing over here is opportunity. Now, whether currencies are rising or falling, there's always a chance to make money. So this is one very nice thing about Forex. Either the market is going down or going up, we will always make money compared to other money market like stocks and the rest. You know, when you buy a stock and it's dropping, you're basically losing. All right. Well, then it's all the same thing. But then the main idea here is in Forex market, we always have opportunity. Either the market is rising or falling. And now the fourth thing here is flexibility. Forex trading gives us a whole lot of flexibility. We're able to do anything we want to do at any time. We're able to travel anywhere we want to travel at any time. But then this is when you make it in Forex. Now, who are those that trade Forex? Starting with the institutional traders. These are traders who work for large banks, investment firms, and other financial institutions. These are, big traders. These are traders that work for very, multi-million industries. All right, these are big traders. And then we have central banks. So the central bank, for example, the United States Central Bank, European central banks, they are also partakers in the Forex trading market. And then we have corporations and multinational companies as well. We have Forex brokers. Brokers is actually individuals or firms that act as an intermediary between you, that is you and I, and the Forex market. They're the ones that actually gives us the opportunity to be able to enter a Forex market. These are the brokers. But then they also partake in Forex trading. And now, continuation, we have speculators. This is where you and I fall in, the retail traders. All right. We basically trade, for the main aim of just getting our profit and coming out and the rest. And then we have investors and portfolio managers as well. And finally, in the list here, we have market analysts and economists. All right. Although these are people that actually just analyze, but then they also partake in one way or the other in Forex trading. Now, getting started with Forex trading. Now, I believe everyone watching this video right now, let me assume everybody watching this video right now are all newbies, all right? Or you've, heard about Forex one way or the other. But then I'm going to be explaining, like I said, from the start, as if you are all, 5 years old, all right? Now, the basics, you need to understand the basics of Forex markets. All right, you need to understand the key terms like what the PPs, what exactly is lot size, what exactly is leverage, what exactly is a margin. All right. And now the first basic you must understand is the buying and selling, which I already explained. Whenever you're buying in a particular Forex market, for example, let's say we're looking into GBP/USD Forex market. If I am buying, I am simply saying that pound is going to beat dollar. And if I'm selling, I am simply saying that dollar is going to beat pounds. That's basically how it works in every single Forex market out there. Now, the other basics, talking about the terminologies, we'll be going into that in some minutes. Now, the next thing after you understand the basic is to choose a broker. A broker is actually your gateway to the Forex market. Like I said, a broker is the intermediary. The broker is the firm that gives you the opportunity to enter a Forex market. Without the broker, you cannot enter the Forex market. The broker is the one that gives you the opportunity, that gives you the chance to be able to trade inside a Forex market. All right, like me, I basically use XNES for my trading, but then you can as well select several other brokers out there. Now, the third thing on the list here is you need to practice on a demo account. All right. So now we have what we call demo accounts. Demo accounts are actually accounts that your brokers give you so as to be able to practice based on what you've learned or based on a strategy, just to practice real time. All right. You are practicing on the real market. You understand? So that's basically what demo is about. So you want to practice with a demo account rather than just rushing into a real account. You want to ensure you understand at least how the trading work with a demo account. All right. So now once you've actually registered with your broker, you can simply request for a demo account. And now once you have a demo account, all you have to do next is to head to a technical analysis software or a chart software, that can actually expose you to the market actions. For example, we have TradingView, we have MT4, MT5, etc. Once you create an account with your broker, all you have to do is to connect that account with either MT4, MT5, or TradingView, whatever software you are using to look at the chart. All right. Then, aside just looking at the chart, it will also help you in making your executions. All right. So as you guys can see over here, practice on a demo account. Start with the virtual money to practice your strategies and get comfortable with trading platforms like MT4 or MT5. Now, the fourth thing here is to develop a strategy. A strategy is actually very, very important. And one thing you must ensure you do not do for you to be successful in Forex trading is once you select a strategy, once you notice the strategy wins or it's okay, you do not want to be switching from one strategy to another. One thing you must note is in Forex trading, we would always lose. All right, it's a normal thing. We lose, we gain. But then the amount of what you lose is dependent on how you manage your risk. But then your strategy also can be a winning strategy, this week, and then next week it might not work well. But then whatever strategy you're going to be going for, you want to ensure you pick it and you grow with that strategy. So before you select a strategy, make sure you practice that strategy very, very well on demo accounts, on back testing and doing several other actions before you say that, yes, this is the strategy I am going to be using. And then once you select that strategy, you want to ensure you stick with that strategy. Now, the next thing here is you need to start small. All right, very important. You need to start small. When you feel you've actually gotten used to the market, at least with the demo accounts, you can start by using, or by depositing a small amount of money with your broker and then connecting that account, that is the real account, with that small money with either MT4, MT5, TradingView, whatever software you want to be using to execute your trade. That is whatever software you want to be using to place a trade. All right. So now once you feel you're ready, you can start by depositing a small amount of money and you can start. And now, one thing you must understand is that demo accounts, the way you behave with a demo account is going to be totally different from a real account. So it's always better to, practice the demo, even if it's going to be just for 3 months, all right, and then head to a real account. So you can experience the real psychology, the real emotions. It's when you start experiencing the real thing, that is when you even learn, feel, and grow faster. All right. Now, moving to the basic terminologies that I talked about. Now, these are actually the terms, these are things you're going to be hearing when you start trading Forex. The first one here is buy. When you say buy, I want to buy in a pair, I want to buy in the Forex market. All you're simply saying is you're purchasing the first currency. All right, you're simply saying that the first currency in that particular pair is going to beat the second currency. All right. And now the next one here is sell. If you're selling, you're simply saying the second currency is going to beat the first currency in that pair. Now, the next terminology here is a broker. A Forex broker is a company or individual that facilitates the buying and selling of currency pairs by providing a trading platform and charging a fee or spread. All right, so the broker is basically the one that gives you the access into a Forex market to trade, and we have different Forex brokers like MT4, MT5, IG, Forex.com, XNES, and several other brokers out there. Now, the next thing here is pips. This is something you would hear very, very well. Pips. So pips are the smallest price move in the Forex currency pair. It's just like the step. For example, as a human being, you make steps, you step, you move left, right, you're making steps. So that movement you make as a human being, in the case of a Forex market, the movement that the price moves, that is, let's say you buy at a particular price and then it moves upward. All right, let's say it moves upward 15 times. So that 15 is what we call a peep, all right, of peeps. All right, so the difference in when you buy and then the movement is what we call the pip. So what I given an example here, if the euro USD moves from 1.1 to 1.10005, that's a 5p movement. So that's just an example. All right. So now next terminology is over here, starting with leverage. So leverage is the ability to control a large position with a small amount of capital. So I explained this earlier on. So leverage is actually being given to you by the broker you select. Now, based on the capital, that is based on the money you deposited with your broker. Like I said, the broker is the one that gives you the access into a forex market. They serve as the middleman between you and the forex market. So now there's something we call the leverage that the broker offers. Now, based on the capital you deposited with your broker, let's say you just deposited $10 or $100, whatever amount. Now, with the help of this leverage, all right, with the help of this leverage, the broker would give you more power to trade more amounts of money with bigger positions. For example, if you just have a $10, you have just a $10 with your broker would not allow you to be able to make trades that would actually, that would be bigger than that capital. Trades that, maybe it moves in just few pips and then your money is zero. You understand what I'm trying to say? So your broker would not allow you to be able to make trades that would actually suck your entire money. Instead, they would limit your risk. And now this leverage is being provided by the broker in case you are trying to tell your broker that, don't worry, I know what I'm doing. Don't worry, you don't need to protect me. Don't worry, I am okay with increasing my leverage from maybe 100 ratio 1 to like unlimited ratio 1. You're basically telling your broker that, don't worry, don't protect me. I know how to control my risk myself. Just give me the opportunity to open bigger position. And yeah, your broker is gonna allow you. All right. So leverage is one tool that is actually provided by the broker to give you the opportunity to enter for bigger positions. But then note that the bigger the leverage, the bigger the risk, because if you actually put a very big leverage, even if the position you're trading in is actually moving in few pips, but because you actually traded with maybe a bigger lot size, because you allowed a bigger leverage, then before you know it, your account can get blown. So it's something that is very, very important. But then the benefit of leverage is it gives you the opportunity to trade a bigger position with a smaller profit or smaller capital you deposited with your broker. As we proceed, I'm sure you all would understand better. Now, the next thing here is risk. So risk in Forex refers to the potential for losing money on a trade due to the market movement against your position. This is very, very crucial. And this is one thing you must understand, that in Forex, there is always risk, and there's uncertainty. You don't know what might happen. But then the only thing that can help you is what we call risk management. All right. Risk management is very key. In fact, for you to be successful on the long term, you need to become an expert in what we call risk management. You must know how to manage your risk. Very, very crucial. All right. So example, using stop loss orders and limiting the percentage of your capital used per trade can help manage risk. So there's something we call stop loss and there's something we call take profit, which I'll be talking about in some minutes. And now the next thing here is what we call spread. All right, spread. So spread is the difference between the buying and selling price of a currency pair. For example, we have Euro USD has a bid price, which is actually the selling price of 1.1, and a ask price of 1.1002. So the spread is simply the difference between the buying and the selling price, which is actually 2 pips. Now, the next thing here is what we call lot size. So lot size refers to the quantity of the currency pair being traded. So a quick example, when you say lot size, do you know that you and I, that is another trader, can be trading based on a particular strategy that I am also using in the market at the same time? And then we enter the same, action, we execute the same trade at the same time with the same buys, let's say buy order. All right. But then because the trader used a lot size of 1, and I use the lot size of 0.01, even though the market is moving in our direction, the person who used the lot size of 1 would actually earn way more than me who used the lot size of 0.001. So the bigger the lot size, the bigger the risk. The smaller the lot size, the smaller the risk. And then the bigger the lot size, the bigger the risk, or the bigger the profit. And then the smaller the lot size, the smaller the risk, and then the smaller the profit. All right, so lot size is also very, very important. Your lot size is what will determine how much you gain or how much you lose. All right. Now, continuation on the basic terminologies. Now, currency pairs. All right, this is simply the two currencies, that is the base and the quote currency, which we explained earlier on. And now there's something we call ask price. All right, so ask price, which is actually always higher than the bid price. All right, this is the price at which a trader can buy the base currency. All right, that's like the current price in which the trader can buy a particular currency. And then the bid is the opposite, that is the price in which a trader can sell the base currency. Now the next thing here is what we call margin. So this is the amount of money needed in your account to open and maintain a trading position. It's related to leverage. All right, so there's something we call margin. So margin is actually the amount of money you need, all right, to be able to open several positions. For example, like I said, just a layman explanation. Let's say you're inside a trade. For example, you're trading, all right, you're trading right now, and then your trade is going in your direction. The trade is going in your direction, so definitely you'll be having a very an increase in your equity. There's something we call equity too, but then your money will be increasing. That's the layman explanation. Your money would be increasing. Now, as your money is increasing, your margin, all right, would also increase. That is, you'll be able to open more positions because you're already having more money. All right. So because you're having more money, you'll be able to open more positions, and vice versa. If the trade is actually going against your direction, your margin will probably reduce. All right. Okay, because the amount of money you would need to open more positions would actually reduce based on your margin, because now you're actually in a bad situation, so you wouldn't have enough money to open more positions. But then if the trade is going in your direction, all right, you'll be in a good position to open more trades. All right, so that's just the layman explanation of margin. Now the next thing here is what we call stop loss. So stop loss is basically a feature in trading that helps you limit your losses. All right, so let's say you're in a trade, all right, and the trade is not going in your direction and it keeps going against you. So stop loss is the order you place in order to tell your broker to remove you from the trade once it gets to a particular amount that is against your position. For example, you placed a trade at $1,000, for example, all right, and then you're saying that, oh, I believe that this trade is going to go to 2,000, so I decided to buy. But now, instead of it going to 2,000, it decided to go down. All right, so it began to go around $900 or $500. So stop loss is more like, okay, how much money am I willing to lose? All right, so let's say you set your stop loss at $500. All right, so once it gets to that $500, your broker removes you from the market. All right, so same thing applies to take profit. Take profit is when it is going in your favor this time. How much money do you want to exit with? All right, so take profit is just to ensure that, okay, at least you come out with something rather than being greedy. All right, so take profit and stop loss are very, very important when you're placing a trade. Stop loss helps you to control the amount of money you lose, while take profit helps you to control the amount of money you gain. All right, more like locking profits. Now, some other terminologies. We have volatility. All right, this is the measure of how much and how quickly the price of the currency fluctuates over time. So we have different currencies, different forex currencies pairs, and then each of them has their own volatility feature. There's some currency pairs that are very, very volatile. That is, they fluctuate very fast over time compared to some others. Some others move very, very slow, while some move very fast, meaning that you can lose very fast and gain very fast if it's actually a very volatile market. And if it's a low volatile market, that is, you can gain slowly or lose slowly. All right, that's just the layman explanation. Now, the next thing here is technical analysis. So now, technical analysis is basically the study of the historical price data and chart patterns to predict the future price movements in the forex market. All right, so this is something you must understand. There are two basic analyses in forex market. We have fundamental and we have technical analysis. So technical analysis is basically used by so many traders like you and I compared to fundamental. So technical analysis is more like looking at, okay, how did the price do in the past? How did the price move in the past at this position? How did it move in the past at this position? Okay, and then you want to use the historical data to predict what it might do today or what it might do tomorrow. It's basically technical analysis. While fundamental analysis deals with the news. All right, you're looking at the news data to predict what would happen to the forex pair. For example, let's say we're looking at GBP USD, and then there's a news today for pounds. All right, so then I'll be looking at the news and then be trading based on what might be the outcome of the news. So that's fundamental. And now some others here, we have bear market. Bear market is simply a market where the currency is falling. All right, if you look at the overall currency, it's actually falling. And then we have bull market. Bull market is a market where the price of the currencies are rising. All right, later on I'm going to be showing you guys an example of all this on the chart directly. All right, and now we have what we call order types. All right, order types. Order types are simply how you want to execute your trade. How do you want to enter the market? Okay, do you want to enter directly? There's something we call direct orders. That is, you just want to click on buy or sell, and enter the trade directly without wasting time. And then there are some we call limits, and there's some we call stop orders. These are like placing an order. You're not entering directly. Instead, you're placing an order that, okay, when the price reaches this particular price, when the market reaches this particular price, take me inside the market or buy, or when it reaches this particular price, sell. All right, so once again, we have three major types of orders. We have the direct execution, that is, you just want to click on buy and then you're inside the market, or you want to click on sell and you're inside the market. Or we have the limit. Limit is you're simply saying that, oh, it's going in my favor, but I want to enter when it drops to a certain level. I want to give myself more opportunity. And then stop orders is more like saying that, okay, when it begins to go in a particular direction, all right, I believe that once it reaches this price, it should continue in that direction. All right, so that's basically the layman explanation. As we proceed, you all would understand better. All right, so now this is the other types. All right, so now other types. So the first one, like I said, this is market execution. This is direct. When you've registered with your broker, all right, whatever broker you want to use, and now you're inside the platform you want to be using to execute. It can be MT4 or MT5 or TradingView, whatever platform you want to use to execute the order. I repeat, the broker is the one giving you the access into the trading market, that is the forex trading market, and they are also the ones that would give you the account. All right, either the demo or the real account to be able to execute inside this execution platforms like MT4, MT5. So that's the importance of the broker. So once you select a broker, all right, you create an account with them. You create either a demo account or a real account with them. The next thing you want to do is to select the execution platform you want to be using. It can be MT4, it can be MT5, it can be TradingView. Once you've selected it, all you have to do is to link. There's a provision in this execution software to link your accounts that you created with your broker inside the execution platform, and then from there you can start executing your trades. All right, so market execution is simply direct execution. All you want to do is to either click on the buy on your execution software. You're either clicking on buy or you're clicking on sell directly. You don't want to wait. You just want to, once you see something on the market, you just want to buy or you just want to sell. So that's that's the direct. Now the key features here is it's immediate. As you guys can see, it's the fastest order type. Like once you click on buy, you're entering. Once you click on sell, you're entering. All right. But then some effects here is you might experience some slippage. Okay, you might, as you guys can see, you may get a slightly different price from the quoted one. All right, because it's possible your broker is sluggish. It depends. All right. Now the next one here is the stop orders. So the key explanation of stop orders here is it's more like, okay, you're inside the market. All right, you're inside the market. Now when the market is moving, let's say upward, for example, it's moving upward and you believe it to continue to move upward, because when you say a market is moving upward, it means the market is going buy, right? That is, it's going bullish. All right, it's going bullish. That is, it's an uptrend market. All right, so now you believe in terms of what we call a stop order based on buy stop. It's called buy stop. All right, based on buy stop, you're simply saying that, okay, the market is moving upward, but then once it reaches a particular price, I believe it's going to continue upward. That is what we call buy stop. For example, as you guys can see here, Euro USD is at 1.1, for example. Now, you now place what we call a buy. We have buy stop, we have sell stop. But then for buy stop, you're simply saying that, okay, I believe this price is going to continue to go up. And then by the time it reaches 1.105, execute the trade. You're telling your broker, okay, execute my buy stop trade, because you believe that it will continue to go upward. That is for what we call buy stop on the stop order. Now for the opposite, which is sell stop, this time it is the opposite. That is, you believe that it's going downwards. When it reaches a particular price downwards, you believe it's going to continue to go downwards, and then you make a profit. So that's what sell and buy stop is about. These are basically under what we call stop orders. Now the next one here is what we call limit orders. In this case of limit orders, rather than saying that it's going to continue to go up, you're saying that, okay, for example, let's start with, we have two types of limit orders as well. We have the sell limit, we have the buy limit. Now for the buy limit, all right, for the buy limit, you're simply saying that, okay, let me just come out to show you guys real quick. So for the buy limit, let me use this. Let's say now you're looking at buy limits. You're simply saying that you believe that the market is going to keep going down, all right, and then once it reaches a particular price, it's going to start to go up. So that is what buy limit is about. Okay, so I'm saying that, okay, I believe this market is going to continue to go down, and once it reaches 1.21, as you guys can see at the extreme right here, once it reaches 1.21684, it's going to start to go up. That is what we call buy limit order. All right, you would have placed the buy limit order at this price, so immediately it touches the market, the candlestick touches this particular area. Okay, depending on whatever happens, if it's going to go up, that is, you're going to be in profit. But then if it continues to go down, it means you're simply going to be in what? Loss. All right, you're going to be in negative. But then because you believe once it reaches here, it's going to spike up. All right, so either way. All right, so that's for buy limit. Now for sell limit, it's the same thing, but for sell limit, this time you're saying that it's going to be going up. All right, and then once it reaches a particular price upwards, you believe it's going to what? Bounce down. All right, and then if it continues, if it continues rather than bouncing down, so far it has touched this, you're inside the trade. So rather than coming down, let's say it continues, it means you're going to be in what? Negative. I repeat, for buy stop, all right, for the stop, for the normal market execution, it's direct. You're either buying or selling. As you guys can see here, sell or buy, it's direct. You can click on it, it buys. You can click on it, it sells. That's direct order. For the stop orders, all right, for the stop orders for buy stop, I'm simply saying that, okay, the candlestick is going to continue to go up. It's going to continue to go up, and by the time it reaches a particular price, I believe it's going to continue to go up. If it continues to go up for the buy stop, it means I'm going to be in profit. All right, and then if it's rather than going up, it comes down, I'm going to be in what? Negative. So far it has what? Touched the price. All right, a normal person, in case of a buy stop, all right, when you're trading the buy stop, you're going to set what I call the take profit, which I explained earlier on, and then your stop loss. So you're going to set your take profit. Okay, maybe once it reaches there, I believe it's going to continue till it reaches this area, for example. And then you're going to set your what? Your stop loss. Let's say it hits this, and rather than going up, it begins to come down. Okay, I am okay to lose at this particular price. All right. So now this is based on let me show you guys so it to be more clear. All right, so now let's say this is a buy stop. All right, and now it has triggered this particular position. I'm saying that it's going to continue till it reaches here, and once it reaches here, I'm going to set my take profit. I'm telling my broker to remove me in this profit. But then in case rather than going up, let's say it hits this particular price, it begins to come back down, I am setting my stop loss at this area. I'm telling my broker, okay, I'm okay with losing this. And the same thing applies to the sell stop. All right, the same thing applies to the sell stop. This time, rather than going up for the sell stop, we're talking about going down. All right, so sell stop is more like, okay, I believe it is going down. It is going down. It is going down. I believe that once it hits this price, it's going to continue to do what? Go down. So I'm going to be setting my stop loss at the top. All right, in case rather than going down, it starts to come up. And then I'm going to be setting my take profit at the bottom. All right, so that's basically how it works for the buy stops and then for the limit orders. So let's go back to the slide. All right, now key tips for beginners or newbies. This is basically from my experience. All right, this is from my experience as a trader. All right, so now first things first, you need to understand the basics. You need to understand candlestick patterns. You need to understand psychology. You need to understand what exactly is risk management. You need to understand all the basic, the terminologies and the rest. And then you want to start with a demo account. You want to start with a demo account. You don't want to rush. Okay, you want to take it step by step. All right. But the main idea here is you want to fail fast so you can learn faster. Fail everything you can fail early so you can learn faster. You should learn from your failures. Okay, you have to achieve failure in order to win. Failure is there to ask you a simple question, okay, and that is, do you really want to achieve your goal? So it's very important for you to fail fast so you can learn faster. The more you fail, the better you become. That's actually how it works in life generally. Now the next thing here is practice proper risk management. All right, practice proper risk management. This is very, very key on the long term. You must understand that there's something we call risk management. Risk management is more like, okay, I know that Forex trading is a risky, money market game. All right. So if I'm trading, I know there's uncertainty, but then one thing I can control is how much I am willing to lose. If you become a master in what we call risk management, you would never, and in fact, you will hardly find yourself in situations where you trade based on hope. There's something we call trading based on hope. This is more like you just decided to go over leverage, you just decided to enter based on what you feel, and then it starts to go against you. But now, because you didn't put what we call risk management, it's more like your entire capital is at risk. But because you understand what risk management is, for example, let's say you have $100. Let's say you have $100 starting capital. You deposited $100 with your broker. Now, you want to say that, okay, I only want to be risking 5%. That is, you only want to be risking $5. That is, anytime you're entering a trade and you're setting your stop loss, your equivalent stop loss, that is, in case it's going against your direction, you would only be losing $5. Okay, that's what we call risk management. You want to ensure you have a particular percentage, you want to be risking on your capital. It helps a whole lot on the long run. Trust me, it helps a whole lot on the long run. And now the next thing here is you want to stay disciplined. Avoid high leverage. This is very key. You might decide to over leverage today. You're making profit, but trust me, it wouldn't help you on the long run. The main idea is you want to become a long-term profitable trader. You don't just want to become a short-term person that makes money and then loses everything the next day. You're not profitable that way. Instead, you want to stay disciplined and you want to avoid over leverage and trade with a clear plan. You should have a journal. You should have a jotter that you note down how you want to trade. All right. And now the next thing here is focus on mastering a few currency pairs before you expand. This is something very, very important as well. And this is how I actually started. I started with, Euro USD, GBP USD, GBP JPY, USD JPY, those, smaller pairs, before I moved on to the volatile pairs like gold, like crypto, and the rest. All right. So this is very, very important. You want to start, if possible, just start with a single pair. Understand how a single pair works. You don't just want to be trading, randomly jumping from one pair to another pair. It doesn't help on the long run. Okay. Now the next thing here is always keep emotions in check and be patient in your journey. Please, you need to understand that Forex is not a get rich quick scheme. This is very, very important. Forex is not a get rich quick scheme. You don't want to be taking Forex as a gambling game. You don't just want to be jumping into Forex with the hope of making quick money. Nah, it doesn't work that way. Instead, you'll just be losing your money. But the number one thing you want to ensure you have in check is your psychology, your emotions. And now the best way to control your emotions is by taking proper risk management. Because it is when you trade on hopes, you'll notice your heartbeat begins to rise when you start going against your, direction. But then if you're someone who has calculated your risk, you wouldn't be afraid because you already know how much you're going to be losing if it goes against your direction. So this is why risk management is very key, and it helps you automatically in becoming disciplined, and it also helps you automatically in terms of your emotions and psychology. So as you guys can see, it all comes from money management and risk management. Now, continuation. Do not trade on hopes, like I said. Learn to think of how other traders might be thinking based on the market action. This actually came from McDougall's book. Okay, you want to put yourself in a situation where you think on how other traders, because you're not the only one. Like I said, there's liquidity, and there are billions of traders trading every single time. All right, so based on the market actions at that exact time you want to take your trade, you want to think of how would people be thinking? What would people want to do? Would people want to sell at this position? Would people want to buy at this position? Rather than you thinking based on what you think, based on what you feel, you want to put yourself in other, majority of traders. How exactly would they be thinking right now? If you can actually, attain that particular psychology, attain that particular power of, putting yourself in other traders, mind, trust me, it's going to help you on the long run. Now, one thing you must note as well is more trades, more losses. Trading is not like the normal job. Trading is not like the 9 to 5 job where, the more you work, the higher your promotion or whatever. Trading is a game that actually requires patience. It's a game that you don't want to overtrade. Even if it's just one trade in a week, even if it's just 2 trades in a day, okay, you want to take it calmly. The less the trades, the less your losses, okay, and the more you're able to keep your capital. But then the more the trades, even if you win like 5 trades, but then you continue, you can lose every single thing compared to someone that actually just traded once. The person will still have their capital intact. All right, so trading is a game where you need to be patient and you don't want to overtrade. All right, so now trading is an art of patience and discipline. This is very key, trust me. This is what will help you on the long run. You might be making billions and you're not patient or you're not disciplined today. And trust me, on the long run, you're not going to be, profitable. You need to ensure that you attain the master or, the art of being patient in terms of taking your trades, and then the art of being disciplined. These are very, very important terms. All right. And now that brings us to the end of this particular part. All right, that brings us to the end of this particular part on the tutorial on Forex trading for beginners. All right, so now just to add some other things, like I said, in order to get started, what I want you all to do right now is you need to search for brokers, brokers that are regulated. Like me, I make use of Xnest. There are other brokers out there. We have IC Markets and several other brokers. You want to do your research on brokers and go for the one you're okay with. Now, once you go for the broker you're okay with, you also want to go for an execution software. You can go for MT4, MT5, TradingView, whatever software you're okay with for trading. Okay, that's going to be what you're going to be using for executing your trades. All right. Now, once you have the broker selected, you have the execution platform selected, the next thing you want to do is to open a demo account with your broker and then link it with your execution platform to start trading. Now, in my next video, I'm going to be showing you guys the strategy I use that works for me very, very well. In fact, it's like a 76% winning ratio strategy. So make sure to subscribe if you haven't subscribed. Make sure to drop a comment down below in the comment section. Also, feel free to share with your friends and family members. And I want to believe this video has been a whole lot helpful to you all. If you surely learned a lot, make sure to subscribe once again if you haven't subscribed. And I'll see you all in my next and continuous highly informative Forex videos. Thanks for watching, guys, and bye for now.